Afternoon and happy Thursday. We have a lot to cover here this week with a big week in earnings reporting, Fed decision, and that decision actually kind of tees up a great question of the week, really about gold and silver and how that kind of plays into portfolios and what's going on in the world these days. So before we get into it, my name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, the data, the trends that we're watching, and hopefully weed out some of the noise along the way. Before we get into the really key areas around, mostly the Fed, but the earnings and the Fed and our question, I want to touch briefly on consumer confidence. Consumer confidence numbers came out last week and was up again, falling pretty well in line with the consumer sentiment numbers we got the week before. So I think this just kind of supported that the consumer is feeling very good about things. Second thing I want to touch on is earnings week. So here we are, the week of July 24th, and we have a huge week in terms of earnings. It's not the most companies reporting, that's actually next week, but it is the most market share reporting. We've got, Meta, Microsoft, Google, you name it, all the big names are reporting here this week. Really, a lot of these companies are beating the expectations pretty handedly as well. I think it was kind of expected that may come up here, but nonetheless, really important to watch. And then as we get into next week, maybe we'll summarize a little bit more on earnings, because going into next week, we have a number of more companies reporting as well. Main point here this week, which of course is the Fed decision, and more importantly, the Fed press conference. So the decision was, I think, pretty straightforward. I think we all kind of expected exactly what came up. The Fed hiked 25 basis points, and so now has raised 5.25% since I think early 2022 is where they started hiking rates. All right, so 25 basis points here again, 0.25%, in case you're not familiar with that term, basis point. And I think what was, maybe most important to touch on through this is not necessarily the decision. I think a lot of people expected that for this July hike, but really the press conference that followed and what we can kind of, take out of that as far as what may come all the way out to a mid-September meeting. The Fed had shared that they're going to take it meeting by meeting. It was very adamant on that they're really going to take this as the data unfolds. And so I think that what was interesting was that heading into this meeting, I think a lot of the stock market, bond market was pricing in the fact that the Fed was not going to hike next meeting, like no chance of it. As we look now after the conversation yesterday, that has shifted quite a bit. And now the bond market, for instance, is pricing in a little bit of a probability, or sorry, not a probability, a possibility that the Fed does in fact hike next meeting. And I think a lot of that came from the terminology that the Fed chair Powell had kind of shared. He had mentioned that inflation remains well above their longer term goal of this 2%, which, for whatever reason seems to be the magic number. What was also very important, and we talk a lot about this, but he had highlighted core inflation data as the key to watch again and again and again. So you've heard me share that before, where the headline inflation data point certainly looks much, much better, but core is really the number to watch. He had shared that core typically gives us a sense of where inflation is going. And, obviously with the headline inflation data, just to reiterate here, it includes some of the more volatile things like energy and food. Core takes those out. So core inflation is really the number to watch here, especially if you're trying to get an idea, a pulse on what the Fed may do ahead. He shared they haven't made a decision to go every other meeting. It's not something they even looked at. They didn't even really talk about the cadence in terms of how they would hike or not, but haven't made a decision on pace or anything. He did share that the June CPI, the June inflation data, was welcome. He was happy to see that the core number did drop slightly, but he had shared time and time again it was only 1 month's data. There are 2 more jobs and inflation reports between now and next meeting. And so he shared time and time again, they're going to continue to watch that data, and they will not make a decision until we get closer to that September meeting. There wasn't a lot of movement, to be honest, in either the stocks or bond markets through this entire thing. And in fact, markets opened, up a little bit, but nothing significant. So typically we see kind of either a pullback or a run in the market, and the next day the market digests a little bit and goes the other direction. To be honest with you, for this press conference itself, there wasn't a lot of movement one way or the other. Again, I think the bond market, though, was maybe the shining point to kind of like to pay attention to, because the bond market definitely priced in a little bit of a shift in possibility as far as the Fed hike coming in September. I think that all this, by the way, is right ahead of a PCE inflation data point tomorrow. So get ready. I think I just shared kind of pointed to the fact that they certainly are keeping a hike on the table. But he did share monetary policy he believes is restrictive and is putting downward pressure on economic activity. So I thought that was a big takeaway from the conversation. Clearly, they feel that the hikes are starting to do their job, and that not only is it slowing inflation, but economic activity as well, which may sound counterintuitive, but that is really what the Fed is trying to accomplish, because if that doesn't happen, we continue to spend, prices continue to go up, and so on and so on. The data rolls out the way it has, like, let's say it continues to drop, that the Fed may be, I don't want to say closer to done than done, but nonetheless, at least starting to explore a little bit longer of a pause here. But even if they do, what I want to share to keep very, very clear is that they shared they're keeping rates high for long. They don't expect inflation to come anywhere near 2% until 2025. Okay, so keep that in mind. There's a lot of markets pricing in the Fed decreasing rates next year. He was very clear, and it's impossible to predict that far ahead, but he was very clear that they don't plan to do that unless they see significant changes. Before we wrap up, we have a great question of the week here this week, which is basically about gold and silver investments. And I think it's very timely given the Fed, back in focus here. So to kind of put this in context a little bit, gold and silver, when looked at as an investment, is typically seen as kind of a safe haven investment. Typically, the reason that people buy gold and silver is for safe assets, something that is there, maybe physical if you'd like, but something that ideally doesn't necessarily go down, something that can be relied on to some degree. We start to see some of those concerns surface. Typically, gold does very, very well. Now, this recent cycle has been a little bit different. And I think a big reason for that is because a lot of the I don't want to say the typical gold investors, but people who might have turned to gold at that time actually were going into cryptocurrency, which obviously we all know what has happened there, and how that did not quite work for this particular purpose, the other way, in fact. And so I think we're starting to hear more about this now, because people are getting, still concerned about inflation. Obviously, markets have had a big run. And so we're hearing a lot more about these safe haven type of assets. But what we're starting to see, have started to see, is that I think a lot of the Bitcoin money that went to go hedge against this risk has now maybe started to go back into these more traditional precious metals. So to be clear, it can be a good asset typically. Like if you look historically in inflationary times, as the dollar becomes less valuable, obviously the value of a physical asset like gold or silver can be worth more. Now, I think that a lot of people also like the physical quality of it, right? Especially if you buy like a gold bar or something and put it in a safe. I think that's part of it. But keep in mind, for an investment, liquidity can be an important factor as well. So obviously, you don't want to have too much in gold bars, because if a medical bill comes up, it's not very likely you're going to go shave off a piece of that gold bar to create some liquidity for a bill when needed, right? Nowadays, there are definitely more liquid solutions out there. There are ETFs, things like that can help you. But it is becoming, a kind of a hot topic again, so to speak. And so I wanted to break it down a little bit. To be clear, as with anything, I think we need to be cautious in how much exposure and how we use these investments. There certainly might be a place for it, but be cautious of going too far into this. There's a lot of these like self-directed things out there where they're suggesting you put all your money into this, and obviously that is not something I would suggest, but nonetheless there might be a place for it. And so certainly something worth exploring a little bit, especially during these inflationary times is when these things tend to be a topic of conversation. So thanks so much for sending that in. I thought that was a really good topic to cover as the Fed continues to hike, as we deal with inflation, and as we see what may be on the horizon here. Thank you guys all so much for joining us. Be sure to tune in next week. We'll break down earnings. We'll break down the PCE data that we get and start to head into a jobs week there as well.